Welcome to today's Explainer. If you've ever found yourself wondering how the world's biggest corporations actually make those massive billion-dollar decisions, well, you're in exactly the right place. Today, we're diving into the absolute core of financial management. We're going to use the ACCA FM framework to decode the high-wire balancing act of corporate finance.
Because really, everything we're talking about today orbits around one massive question. How do you build a financial empire without losing it all? Every single financial manager, whether they're running a scrappy local startup or a massive global conglomerate, faces this relentless, high-stakes trade-off between risk and reward. I mean, pull one lever and your profits might absolutely skyrocket, but pull it just a little too hard and the whole company could literally come crashing down.
So here's our roadmap for today's Explainer. We'll start with raising capital through equity, then we'll look at the debt alternative. After that, we'll unpack gearing and financial risk, and finally, we'll tackle the dividend decision.
All right, let's jump right into Section 1, raising capital, specifically focusing on equity and debt.
So imagine you're a CEO and you desperately need cash to build a new factory. Your first option, equity. This is permanent capital. You issue ordinary shares, which means you're giving away voting rights, but on the flip side, you totally avoid mandatory fixed dividends. Now you might be thinking, great, no forced payments. But here's the catch. Equity is actually the most expensive source of finance. Why? Well, it's because the required return for shareholders is the highest. They sit at the very back of the line if the company goes bankrupt, meaning they take on the absolute maximum risk. And as we know, higher risk always demands a higher return.
But what if you want to raise that equity without handing over voting control to a bunch of complete outsiders? You know, keeping it in the family. A really common strategy here is the rights issue. This is where you offer new shares to your existing shareholders, usually in proportion to what they already own, and typically at a nice discount to the current market price. It's a win-win. It rewards your loyal investors and keeps control right there inside the house.
So how exactly do we price this? Well, that brings us to TERP, the theoretical ex-rights price. Because you're issuing new, cheaper shares, your company's overall share price is naturally going to drop and find a new balance. It's kind of like mixing hot and cold water. TERP is just a weighted average formula to find that exact landing spot. You basically combine the value of your existing shares with the newly issued shares to predict where your new market price should theoretically settle.
Okay, let's pivot to the other side of the coin. Debt. Selling shares is expensive, right? But borrowing money? That's cheaper. And honestly, the absolute best part about debt is the tax shield. Interest payments are tax deductible, which practically subsidizes your borrowing. Plus, you don't dilute your control. And there's this fascinating psychological benefit. Having to meet regular bank payments has a strong disciplining effect on management. It literally forces them to run a tight, efficient ship. But, and this is a massive but, that interest is mandatory. Miss a payment, and you're staring down the barrel of default.
So there you have it. This is the classic trade-off that literally keeps financial managers awake at night. On one hand, equity is safe for the company because those dividends are totally optional, but it's incredibly expensive and you lose some control. On the other hand, debt is cheap and super tax efficient, but it carries that heavy, terrifying anchor of mandatory default risk.
Moving on to Section 2, gearing and financial risk.
The moment you choose to take on debt, you introduce a completely new dynamic into your company's DNA. This is called gearing, or you might know it as leverage. It's simply the proportion of debt in your capital structure. The formula is just debt divided by debt plus equity. When you pull that debt lever, you increase your fixed interest payments. And what that does is make your remaining earnings wildly volatile for your shareholders, which directly drives up your overall financial risk.
Now, two highly influential academics, Modigliani and Miller, mapped all this out in theories that completely changed finance forever. In a purely theoretical world with absolutely zero tax, they proved that gearing doesn't actually matter. Your weighted average cost of capital, or WACC, stays completely constant. But let's step back into the real world for a second, the with tax scenario. Because interest is tax deductible, Modigliani and Miller show that as you add more debt, your overall cost of capital actually decreases. Suddenly, debt looks incredibly, almost shockingly attractive on paper.
In fact, according to that specific tax theory, the mathematically optimal level of debt for a company is 100%. Yes, literally 100% debt. But obviously, we don't look around and see companies running entirely on bank loans. Why not? Well, because the theory ignores the very real, very terrifying threat of bankruptcy. At 100% debt, one single bad month of sales, and the bank is taking your keys.
If you take absolutely nothing else away from this section, make sure it's this. Gearing is your debt proportion. Higher gearing equals higher financial risk, But the reality of tax makes debt cheaper. It is a constant, incredibly delicate balancing act.
Which brings us to Section 3, the dividend decision, payout versus retention.
Let's fast forward in our corporate journey for a minute. You raised the money, you managed the risk, and hey, you actually made a profit. Great job. But now, what do you do with that cash? This is the ultimate tug of war. Do you retain that cash to fuel future growth, or do you pay it out as dividends to keep your current shareholders happy right now?
Academics have literally argued about this for decades. Modigliani and Miller actually pop up again here with their irrelevance theory. They argue that in a perfect, frictionless market, dividend policy doesn't actually affect the share price at all. But, investors are human. The bird-in-hand theory argues that investors much prefer the absolute certainty of cash in their pockets today over the vague promise of growth tomorrow. And then there's the tax preference theory. This one points out that sometimes capital gains on a rising share price are taxed lower than dividend income, which makes retaining cash way more attractive to certain wealthy investors.
But out in the practical world, a CEO usually runs through a mental checklist. First, do we have good investment opportunities? Second, do we actually have liquid cash, or is it just accounting profit on a spreadsheet? Are there legal restrictions blocking a payout? And then, absolutely crucially, signaling. If you suddenly cut your dividend, you signal to the market that you lack confidence, and man, your share price will likely tank. Finally, you have to consider the clientele effect. Basically, companies attract specific investors who really like their unique dividend habits.
So ultimately, dividend policy is just this relentless battle between payout and retention. And make no mistake, it absolutely affects your share price through market signaling and that clientele effect we just talked about.
All right, as we wrap up today's explainer, we really have to ask ourselves why we're pulling all these levers in the first place. Why balance equity and debt? Why stress so much over gearing and dividends? Well, according to the ACCA FM framework, the primary overriding objective is this: the maximization of shareholder wealth. Notice it does not say profit maximization. Profit ignores the timing of cash flows. It ignores risk. Having a profit doesn't even mean you actually have cash in the bank. Maximizing shareholder wealth, which effectively means maximizing the long-term share price, factors in all of that.
But before we go, I want to leave you with a slightly provocative question to chew on. Is maximizing shareholder wealth through these financial tools always the right ultimate goal? I mean, in today's modern era of stakeholder capitalism, where employees, the environment, and local communities are all rightly demanding a seat at the table, does this pure, classic shareholder focus actually hold up? It's a massive question, and it's something every great financial manager is going to have to wrestle with. Think about that for a bit, and I'll catch you in the next explainer.